What does it take to pull off the greatest trade of all time? Today, we break down the biggest wins in market history. We start in 2000 with Sir John Templeton. At the peak of the dot-com bubble, tech stocks were priced for the moon. Templeton, who was already in his late 80s, took the contrarian view. He shorted a basket of 84 internet stocks with roughly $2 to $3 million in capital just weeks before the crash. By October 2002, the Nasdaq had fallen more than 75%. Templeton closed out early, banking around $80 million, a return of more than 2,500%. His lesson, as he put it, the four most dangerous words in investing are, this time it's different. That same year, another skeptic, Jim Chanos, made his mark. From 2000 to 2001, he dug into Enron's shady accounting, off-balance sheet debt, and fake trades, and bet against the stock. Chanos' fund shorted about $60 to $70 million worth of Enron shares, and when Enron collapsed in December 2001, his short position paid off to the tune of about $500 million, an approximate 700% gain. Chanos became forever known as the man who called Enron. Jump to October 1987, Black Monday. Paul Tudor Jones anticipated the crash months in advance. He shorted stock index futures with an allocation of about $100 million, then pivoted into bonds as equities collapsed on October 19th. His fund tripled that year, generating roughly 200% plus returns, with Jones personally making about $100 million. It made him one of the original hedge fund legends. Then there's Jesse Livermore, the great bear of Wall Street. In 1929, he quietly built massive short positions totaling about $10 to $15 million just before the crash. When markets imploded in October, he made an estimated $100 million, over a 600% gain and worth more than $1 billion in today's dollars. His story is immortalized in reminiscences of a stock operator. Fast forward to the Great Recession. In early 2009, when everyone thought banks were finished, David Tepper saw something others didn't. He believed the U.S. government would never let the financial system fail. He loaded up with around $1 billion in capital into Citigroup and other battered financials for pennies. By the end of 2009, his fund was up 120%, pulling in around $7 billion in profit. Tepper himself pocketed $4 billion that year, proof that sometimes the boldest bets are made in the darkest times. But Warren Buffett was just as bold. In 2011, at the height of the U.S. debt ceiling crisis, he struck a $5 billion deal with Bank of America. Preferred stock paying 6% plus warrants to buy 700 million shares at just over $7 each. By 2017, those warrants turned into more than $20 billion in value, over a 300% return on his initial commitment. It became one of Buffett's single most profitable trades ever. Bill Ackman, meanwhile, pulled off one of the fastest trades in history. In February 2020, just as COVID was starting, he spent $27 million buying credit default swaps. By March, when markets crashed, those CDSS were worth $2.6 billion. That's nearly a 9,500% return in just weeks, one of the most jaw-dropping hedges ever. Of course, we can't forget George Soros. On September 16, 1992, Black Wednesday, Soros bet about $10 billion in leveraged short positions against the British pound, believing it was unsustainable inside the European exchange rate mechanism. When the UK government caved and devalued sterling, Soros's quantum fund walked away with a $1 billion profit in a single day, a 10% return on enormous size that cemented his reputation as the man who broke the Bank of England. Michael Burry was one of the earliest to spot the cracks in subprime mortgages. Back in 2005, while most of Wall Street was partying on the housing boom, Burry was combing through thousands of individual loan pools. He noticed a dangerous pattern. Tons of adjustable rate mortgages were set to reset, and when they did, defaults would soar. To bet against this ticking time bomb, he asked banks like Goldman Sachs and Deutsche Bank to create custom credit default swaps, CDS, tied to the worst subprime bonds. That was unheard of at the time. Over 2 years, he committed about $100 million in CDS premiums while investors doubted him. But in 2007, when defaults spiked and the mortgage market collapsed, his CDS positions exploded in value. Scion Capital walked away with about $700 million in profits, and Burry personally made around $100 million, an approximate 600% return on capital deployed. His lonely contrarian bet was so legendary that it became the centerpiece of Michael Lewis's book, The Big Short, later turned into an Oscar-winning movie where Christian Bale played Burry, capturing his eccentric personality and relentless conviction. But if Burry lit the match, John Paulson built the bonfire. Entering just a year later, in 2006 to 2007, Paulson launched the Paulson Credit Opportunities Fund and scaled the same idea to an almost unthinkable level. While Burry was managing hundreds of millions, Paulson went all in with about $500 million in CDS premiums against subprime bonds, tens of billions in notional exposure. When the housing bubble finally burst, the payoff was staggering. Paulson's funds pocketed an estimated $15 billion in profits, roughly a 3,000% return on capital deployed, with Paulson himself personally taking home nearly $4 billion in 2007 alone. That's why his bet is still referred to as the greatest trade ever. If Burry was the visionary outsider insider who saw it coming. Paulson was the architect who scaled it to empire-level returns, cementing both men as legends of the financial crisis. What these trades teach us? From Soros breaking the pound to Paulson shorting subprime, every legendary trade had one thing in common: events. Crashes, policy shifts, restructurings, and crises created rare windows of opportunity. The traders who recognized those events and acted with conviction etched their names into market history. The lesson? You don't need to predict the future. You need to recognize when events are about to reshape the market or a company. Levelfield's AI follows the same philosophy of focusing on events. The platform scans thousands of filings, press releases, and market signals each minute to identify corporate and economic events that have historically influenced stock performance. From buybacks and activist campaigns to CEO changes and government contracts, Levelfields helps investors stay informed about developments that can move markets. It's not about replicating legendary trades. It's about understanding the types of events that shape them and using data to spot impactful moments as they happen. Each week, Level 2 Premium members receive fully analyzed trade setups, complete with entry and exit points, stop-loss levels, and AI-verified data on historical performance. You don't need billions or a Wall Street seat to catch big opportunities, just the right information at the right time. That's what Levelfield's AI Premium gives you. Focuses on events just like top investors, but built for everyday traders who want to act smarter, faster, and with confidence. Follow and subscribe for more. Levelfield's Elite Investing, Effortless AI.